Okay, so for the oral exam, at the end of the exam period, we have the following topics. And obviously, we were talking about the value of the company already. Then we were talking about elements of country risk. Then we were talking about bond markets and all the monetary policy related things, so the different spreads. And then last week we talked about financial lease and its impacts. So now it's time to start with the next major topic, and this is foreign exchange exposure. So what types are there available for us, and how can we imagine them, and how can we hedge all these things? So usually this is one of my favorite questions at the final exams, and if we are checking the lecture notes, also we can see that to be honest, that was the best part of the Jeff Madura book. So the rest of other chapters in the Jeff Madura book, sometimes they were absolutely lazy written, or they were not focused enough, or they were not deep enough, or they were just talking about irrelevant things. In this case, this is really good. So if you are reading only one chapter from the International Financial Management book, especially if they are later releases or issues, then I can recommend that one. And mostly, if we have to think about or consider any exposure in case of foreign exchange rate, then we have to go through the following steps. So if you are just opening a notepad, so this is always the same stuff. So first, what kind of currencies are in the balance sheet or in the profit and loss statement? Can I zoom into this one? Yes, I can zoom in. So this is the first one. The next thing, what we have to remember anyhow, is what is the net position. So expenditures, we have more expenditures than revenues, because in this case it means that we are highly motivated to have appreciation against this currency, because in this case these expenditures will be shrinking down. So or we can say that expenditures are lower than revenues, and in this case depreciation. Yeah, sorry, appreciation of what? The official currency. I mean the currency where we are running our books, and so if you are a French company, then euro is this official currency, so depreciation of the official currency is referred. Well, with so many typos. And once we are able to set up preferences, so the next net position, and also which defines our preferences, then we can see, or we can check also the relevance of this position. So is this exposure relevant? Do we want to deal with this or not? The overkill way is when we are checking that what happens if we are changing the exchange rate, and does it have an impact on the value, on the probability of default. If not, then it's not relevant. So value and probability of default. If it's still relevant, then we have to think about this. Obviously at the same time, so maybe this is 3.A and this is 3.B, it's much better because we have to consider the regimes. So foreign exchange regime. So if it's a floating, then we have to go ahead with some kind of floating and relevant. Then we have to say that, okay, if the currency is floating and relevant, the exposure is, then we have to cover it somehow. So we need some kind of a hedging. So some kind of a derivative is needed. If this currency is fixed, stabilized, so somehow hindered. Also, in many cases, it can happen that under such restrictions, we can't have derivatives. Or some of these derivatives are not available, so not officially banned, just banks will not provide this. Or if it's fixed, then it's irrational to do anything because it's already fixed. So with the derivative, we can fix the exchange rate. If it's officially fixed or stabilized, then we have the same result. So in this case, we have nothing to do. We can just enjoy until the fixed exchange rate regime survives and exists, then we can be really happy. Unfortunately, we know from international finance classes that these fixed regimes usually exist only for a decade, and after that they are collapsing one way or another. So, okay, Bretton Woods system was able to exist for 3 decades, but that's the record. So, anyway, and after that we can consider different derivatives. So in case this exposure floating and relevant and also we know that let's say appreciation is the preference, then we have to check the historical data. We can check forecast, official forecast, or we can go for futures market. And we can see that, okay, we are preferring appreciation. Is this possible or not? Based on past data, based on market forecasts. If it's still possible, then we should nothing to do, so we can say that, okay, then no hedge is needed. Okay, it's okay. For A, if the exposure is floating, relevant, and we are preferring appreciation, it doesn't matter, so one direction, and it's not, so opposite. Opposite move is expected. In this case, we have to use hedging. But still, we have a huge variety of options here, not just options. So one way is that, okay, if we have more expenditures than revenues in this currency, then maybe we should just realize or raise revenues in this currency as well. So this is the simplest way, that let's start provide services in this country to have some revenues, or let's start to bill in this currency to have some revenues. So the easiest way is just to balance out in this way by billing. foreign exchange or by paying in domestic currency. Obviously, in this case, we need some kind of a position to negotiate with our clients and vendors. So yeah, this is the first thing. But we can start. Then otherwise, we can say that okay, let's take up a loan. So natural hedge is when debt is in FX, and also revenues are also. So in this case, it doesn't matter, because if you are realizing all our revenues in US dollars and also our debt is in US dollars, there is any kind of a fluctuation in euro, then our expenditures will change back and forth, but otherwise our debt payments are at least secure. So this is also what many people tries to do, or companies at least. And if still we need something, then obviously we can have options and futures as derivatives. So practically this is what we have to know and remember on the exam and on the final exam and in real life practice anyway, because these are the key steps. So what are the currencies? What is our net position? Expenditures or bigger or revenues? Then appreciation or depreciation is preferred. Then is this relevant? Does it have an impact on value? Probability of default? Then how foreign exchange regime supports us? If it's fixed and stabilized, then it supports us. Otherwise, it's floating and relevant. Then we have to do something. Then we have to decide that should we have to do hedging or no hedging. If we can say that yes, expectations on the market and our preferences are met with each other, then we don't have to do anything. Or in this case, when we are not supported by the regime and also by expectations, then we have to do some kind of hedging strategy, and after that we can decide that how can we balance out the revenues, expenditures, or how can we buy options and make futures positions. Obviously, in this case, futures and options will have a price. So there is this trade-off that if the government says, or the central bank says, that we are fixing the currency against another, then all the expenditures related to this one will be covered by the central bank, especially taxpayers. If they are saying that, okay, we don't want to run this because this is expensive for taxpayers, then they are delegated down to the level of companies. So at the end of the day, they are running these expenditures, and this will be materialized in the form of option fees. And yeah. So now we have to go through all of these things. And first of all, the book starts with the topic of foreign exchange exposure. So what kind of foreign exchange exposures can we identify? One is transaction exposure. This is when we are billing, we are paying, and sometimes when we are making the contract, we have one exchange rate, and then when we have to deliver, there is the other exchange rate. So exchange rate movements during our billing processes can affect our profitability. So this is how mostly companies defaulting, unfortunately, especially in the manufacturing business, where unfortunately, if you are manufacturing retail products, then the margin is already really small in manufacturing. But even if you are manufacturing industrial products, usually you are more secure because they are much more oligopolistic markets. But even at heavy equipment, still margins can be so small that major shifts in foreign exchange rates can hinder companies or render them to default. So there was a bus manufacturing company in the 90s, and they were located in Hungary. They were part of a state-owned enterprise during the communist era. Then, after it was privatized, they were only selling buses to California and in the US. So that was the NABI, North American Bus something company. And so they were not even selling anything to the Hungarian market or to the region. So they were just selling it for US dollars. And they were able to do it, but in the late 90s, there was this sudden appreciation of US dollar, and practically it killed all of their margins. So after that, they had to be, they were not defaulted, they had not to be bailed out, but still they had to go to negotiation with their creditors, and after some consolidation, they survived, and then they defaulted during the great financial crisis or after that. So now I know that they are not existing anymore, but so they were able to do this business for 20 years. Similar thing happened with the complete Canadian TV series production industry. So during the late 2000s and even the early 2010s, many US series were and also movies were filmed in Canada because it was cheaper. But once the US dollar started to depreciate a lot against Canadian dollar and euro and other currencies, practically it killed all the benefits to make shows. So many shows were cancelled because of this in the early 2010s, because after that it was not lucrative anything at all. So, which was sad. And unfortunately, in many cases, companies, medium companies, small companies are just running this transaction exposure, or even big companies. So unfortunately, according to some estimates, maybe 10%, 20% of all transaction exposures in the real economy are covered with some hedges, because hedging is expensive according to companies, and they don't care about this. Or even the book says that we should not do it at the level of companies, because investors eventually they can do hedging if they want. So why to do it at corporate level, which is quite stupid thing to assume, because if the company defaults, then it harms the investor as well. So I cannot recognize the benefits of doing this. Okay, okay, there is a typo. So there is translation exposure, the second one, or accounting exposure. So this is when we have to report quarterly or annually, and in this case there is always this set exchange rate, which is referring on the date of the report was conducted. And in this case, we can have beautiful revenues or jumps in our revenues, because we just have to reevaluate everything or all of our foreign exchange position to this exchange rate. So, for example, Toyota had this in 2013 when the Japanese yen suddenly depreciated. So the Japanese central bank became much more aggressive in quantitative easing. So there was a 10% drop in the value of the Japanese yen, and Toyota was happily collecting this 10% extraordinary revenue from all their international sales, so without doing anything. So this can be always misleading. So if you can see sudden jumps and increases or changes in corporate profit, it can happen that this is only because of reporting. So they have nothing to do otherwise with their cash positions or anything like this. And the long-term exposure is economic exposures, which means that order for position. So how can we stay within this market because of consumption changes, because of our clients, because of our vendors are changing their behavior, or the pricing can be changing. So this is much more like a strategic long-term behavior, unlike the transactional behavior. So yeah, we have to distinguish them. So after that, everything what we will talk about, and also this one, is referring on the transactional exposure. So how can we do this? So what kind of hedging strategies are available? And of course, we can go immediately to derivatives once we considered all of this stuff. And in case of derivatives, we can have futures contract, which is a standardized contract between two parties. One party must buy or sell a standardized asset at a specific date, and the other party must buy this. So you are not able to step back. It's a mandatory agreement. And if you are doing it through a market, then it's a futures contract. If you have to do it through a bank, this is much more like a wholesale customized product, then it's a forward contract. So futures contracts are even for retail clients, so I can make a futures contract, but I have to be a multinational company to be able to make a forward contract with a bank. So usually forward contracts are customized and they are somewhat cheaper at some levels than the futures one. But future contracts has this benefit that we can have expectations about future prices. So if we are just checking this is spot, stock equity indexes, money market fixing, and so on. So where did you move? Let's see, euro overview, maybe. Oh yes, this is what I was looking for. So, as I mentioned before, now they are collecting forwards instead of futures. Why? I don't know. So the futures should be transparent, not the forwards. Anyway, so in this case we can, but this is still interest rate. This is not. Oh yes, okay. This is futures. And now from the CMA that I was trying to show you, just it was not letting itself to show. So we can see that the end of the contract. So right now we can buy or sell US dollars for euros at this exchange rate. And we have to deliver it at March 6th. So it can be really useful because if you have a contract already to sell, or now we have to buy engines from the United States and we have to pay the US dollars in March 7, then we make at the same time when we are signing the contract this futures contract that in this case, so there is the contract is SpaceX for the engines, then the secondary contract is made at the futures market, that okay, we will buy the currency at this specific exchange rate. So after that, we just put this money into a deposit and at least we realize some kind of an interest revenue. Or if we don't have the money, then we are taking up a loan or we negotiate a loan which will be available at that time when we have to make this contract viable. And after that, we don't have to care about what is happening with the exchange rate because now it's fixed for us. The key problem with this fixing is that it requires margin. So we cannot just make up futures or forward contracts, unfortunately, because there is this margin requirement. And that's why I don't like futures market, because this is absolutely non-transparent that what is the size of the futures margin. So originally you have to create an initial margin, but this can be anywhere between 3 to 12% of the futures contract. So you have to keep it as a deposit, so the money should be at the hand of the brokerage firm or the bank, which will make this contract possible. And until then, you have nothing to do with this money. And they are defining this margin on their own. They are saying that, okay, this is linked to the volatility of the underlying product, which is nice, just there is no equation about this. So you just have to provide this. And the problem is that if they are seeing that there is higher volatility on the market, then they can even increase the margin. So this is margin call, and if you are not providing additional collateral to maintain your futures contract, then they can cancel the future contract, they can reduce the future contract to meet with the existing margin, so still it can harm you. And this is, again, non-transparent, so we have no idea. Otherwise, it's really good because clearing houses are the middleman between you and the other counterparty on the futures market. So these margins are there to eliminate any partner risk. So this margin is necessary because after the first great financial crisis of the 1929, they realized that, okay, we need some kind of a middleman, and that's why they created clearinghouse. So even if the counterparty defaults or not able to deliver, then the clearinghouse will step in based on all the money which was collected through the margins. So it's a nice gesture. This provides safety against partner risk, but on the other hand, we have no idea how much money should we keep there. And this can increase if the market is more stressed, which is sad, because if the market is stressed, then also for us it will be also really hard to get any kind of an extra funding. So this can be sometimes dangerous or lethal for companies, especially in the financial sector, when suddenly they have to increase their margins. Yeah, so that's why I don't like futures market in person. Or personally. Then, otherwise, if you have to determine futures prices, practically this is behaving like mostly it behaves like a deposit in a foreign currency, because in this case we can see what are the interest rate expectations. So obviously if this foreign exchange rate is changing from one day to another forward, then we can trace back that what are the expectations about the interest rates. So it can be really useful because we can not just expect what is happening with the currency, but based on this information, we can also see what can possibly happen with interest rates. Okay, these are in base points, so we should divide them by 100 to see what is happening. So that's why it can be quite useful. But also we can see that, okay, this is the market-based futures. There are the calls again. And yeah, and also we can see here already that in euro, the interest rates are also traced back from the future. So usually future interest rate markets and future foreign exchange markets are always linked together, so they are taking the information from each other, which can be quite useful as a source of information. Otherwise, I prefer options, because in the case of option, at least we have some kind of equation where we can define our position and what should be maintained here. So the most simple way is the Garman-Kohlhagen model. This is a Black-Scholes derivative, or a version of Black-Scholes equation, just instead of focusing on shares which are paying us dividends, in this case the dividend is the interest rate, foreign interest rate itself, because in currencies we have domestic interest rate and foreign interest rate. So we can see that this part is completely the same like an option fee for companies, for shares, just here we would have the deposit ratio, and instead of having deposit ratio, now we have foreign interest rate. And also this can be highly familiar because this is the sovereign spread, what we learned at international finance classes. So if the sovereign spread increases, we can see that this guy is here on the top, so it means that the option fee will also increase. If they are narrowing down, then practically it means that their distance is small, so that's why option fees can be way cheaper. Also we can see here that this is volatility here, there is volatility here as well, so obviously there will be two key drivers of the option fee. One is the distance, the difference between the sovereign spread or interest spread between the currencies, and the other is the volatility. So if volatility increases, again the option fee will increase as well. That's why also we can trace back expected volatility. So if people are checking and the option data, so the publicly available option pricing on the market, and then you know that, okay, what are the interest rate expectations because we know it from the futures market. Then after that, you have only one variable missing, and this is the volatility. And all the VIX indices are created from these forward-looking volatilities or implied volatilities. And in this case, we can see that, okay, what is expected by the market? If we can see that this volatility increases in option pricing, it means that the market is not sure about pricing. And if they are not sure about pricing, then this means that confidence is low, so bad times will arrive soon. So this is a really good forward-looking indicator. If we have nothing to do with options at all, these volatility indexes can be really useful. Obviously there is time, so time until expiration. If the time span is small, then obviously we have less risk to add, so nothing will change much until the contract expires, so the option fee will be low. If we are increasing the time, then obviously more and more things can happen, and also it means that the contract will be more expensive. And of course, there is the target. Sorry, this is the spot price. This is the X is the target rate here. Obviously, if we are fixing at a distant exchange rate, then it will be more expensive. And if we are close to the current spot rate, then we can cut also costs. But here is the problem. So first of all, we are assuming that volatility is not changing in time. So this one is not time variant. And we know that this is quite a romantic assumption. So at risk management class during the spring semester, I will talk about options way more. So we will see how we can do this pricing. And mostly the first lesson is about that volatility is not time invariant. This is changing in time, so this is time variant. So the initial Black-Scholes equation was, they had to simplify things, but that one was deadly for them because after that their hedge fund defaulted because of increasing volatility in 1998. So, and the other issue is that we are assuming normal distribution here. Why? Because it's way simpler to define normal distribution, so you need only expected value and you need the volatility of the data, and otherwise we can describe this simply. Unfortunately, normal distribution is way too narrow, so it's hard to use it for real life practices. Still, if we are able to have time variances with gauge models, then we can have a workaround, so people are still doing it. Right now there is one previous student of ours from Morgan Stanley here. If you are talking about this topic with them, they are saying that, oh, this is still robust enough. So if you need fast estimations, then Garman-Kohlhagen is still suitable. Just in many cases they are combining it with some volatility model, and after that it will be good enough. If you are going for the sexy one, then there is the Heston option pricing. This one is a bit more difficult, but also way better, because in this case we can say that, okay, now volatility is not just existing as a number, as a standalone number, but it changes in time. And this change in time is happening because it fluctuates around its expected value. So we have the volatility of the volatility, so how time variant is it? And also we know that how the thing is going back. So this is the kappa is when, okay, we have high volatility, but how fast is it going back to the medium, so the expected level of volatility, and also what is the relationship between the return and the volatility. So because in many cases, if Swiss franc appreciates, then its volatility increases as well, while other currencies, when they are depreciating, then this is when volatility increases, or also for shares. So this correlation should be accounted as well. So in this case, we have nice parameters for the volatility itself to define that, okay, what is happening there. But otherwise, in MATLAB, with proper functions, we can do it really fast. So it's seems to be difficult, but it's not that much difficult. Then, exchange rate forecasts. So as I mentioned before, then we have to see, so if it's a floating exchange rate, not a fixed one or stabilized one, and we can go for historical data set to see that, is this relevant? So if, can we expect appreciation at all? So if we are just going for euro, US dollar, we can see, okay, maybe not from the 70s. Yeah. So we can see that euro, or in this case, this is much more like European currency unit, so ECU until this point. So it always has this sinus curve. So sometimes one is more valuable, like it happened here. So this is when US dollar is appreciating, so US dollar is strong. This is the time when US dollar is weak. But we can see that, okay, there was this ECU appreciation time period, there was the US dollar appreciation time period. Again, there was when the euro was really strong, and nowadays we can see that the US dollar is now it's weakening, but we can see that, okay, this doesn't have any kind of a trend line, maybe on the medium run, but not on the long run. So long run is completely horizontal at this, around this level. There are other currencies like PLN, euro, so Polish zloty, which is also free floating. And okay, if you are not considering this huge depreciation, so let's see from the last 30 years, so they implemented free floating in the late 2000s, and since then we can see that, okay, sometimes it can have high volatility, especially during crisis years, but otherwise this is quite calm and this is not going to anywhere. Sometimes currencies can have this appreciating behavior. So if we are checking the Czech krona, euro exchange rates, it's good to look at the Visegrad countries because we have completely different economic setups. So they are not homogeneous at all. And we can see that they are facing with the constant appreciation of this Czech krona. And it was always funny because during the 2000s, I was able to find many papers which was saying that, oh, this has a terrible impact on their economic growth and their convergence is way slower in terms of real GDP than Hungary or Poland. So they are growing slower. But also they were growing slower during crisis time periods because they are less exposed. And also people are saying that, oh, this appreciation is not good if your economy is open and export-oriented. Because if your currency is depreciating, then obviously you are realizing more and more domestic currency from your after you're exchanging the euros or the other foreign currencies realized from your revenues. But the problem is that in this case, companies are not motivated to invest into productivity. So they can just start at the same productivity level because anyway they can earn more from exchange rate movements. This is not the case in the case of the Czechs because their companies, corporate sectors are always forced to adapt to more appreciations. Only this was the case in 2013 November until April of 2017 when they provided upper ceiling against further appreciation of the Czech krona, because at that time a lot of portfolio investments started to flow into the economy, so they started to behave like a Swiss franc. And the central bank, even vice president of the central bank, told us at conferences that they were afraid of deflation and increasing unemployment because of deflation. So, okay, they kept the exchange rate, but after that they liberalized when they were able to see that, okay, now this hot capital is not going in anymore. And we can see that after it, immediately it bounced back to stronger levels. And we can see that still it's increasing. So it's funny because it reacts to exogenous shock. So that was the COVID case with depreciation, but otherwise it's appreciating a lot. So their real GDP growth is smoother, but less volatile. So it's just going upwards. If you are checking the CHF euro, this is much more disastrous because we can see that, okay, the initial value was 0.6 and now it's more than parity or higher than parity. So this is unhealthy because in this case companies are forced. So it's really hard to maintain any kind of a margin, not just for exporting companies, but even for domestic companies. So when my wife was working in Switzerland as a researcher for a year in Bern, then in the newspapers even there were complaints about that Italian and French and German companies started to deliver pizzas and other food into bordering regions because it was cheaper. Or when her boss wanted to go for shopping, even from Bern, which is in the middle of the country, it was cheaper to go to France to buy something or to Germany to buy something because of, yes, this really strange and adverse exchange rate movements. And this is not the first time, so if you are checking, yeah, so we can see that in the 70s, when after Bretton Woods system collapsed, there was already one time when it was had this appreciation, and it created similar bubbles. It created deflation. After that, it created unemployment. Unfortunately, it was this appreciation had nothing to do with fundamentals. This was completely about flight to safety and buying safe assets for or by external investors. So we can see the same thing here. And since then, usually they are trying to fight with negative interest rates, or once they were capping it between September of 2011 and 2015, they had this upper ceiling, and once they abandoned it, it was jumping up again. So it's quite useless. So we can see that there are different trajectories, or unfortunately, in case of this currency here, we can see that there are depreciating trends in many currencies. That sometimes it seems to be horizontal, but on the long run we can see that this is going downwards. And this is also quite strange, because if we are projecting the difference between the interest rates or even the real sovereign spread, so compensating with inflation, this would be completely contradictory. So the interest rate spread, which should motivate investors to buy the currency and make it stronger if we are maintaining it, in many cases this not appears for emerging currencies. So this is also a really good way to detect that what is the market consideration for a currency. Is this emerging one or the developed one? Because for developed ones, they are behaving nicely. So I had this recent calculation. Maybe it's very simple if we are just checking it, because it was quite a big database analysis, and what is the sample? Yeah, so I collected everything from the IMF database, so everybody here is considered as emerging one, as by the MSCI, and also according to IMF, they are following and maintaining a floating rate, and they are maintaining inflation targeting. And the same is valid for advanced or developed currencies. What you can see here, I was really lucky because both of the subgroups are 11 currencies. I had no idea this will happen, just I was lucky. And then we can see that this is a monthly database from 2000 January until this year. So the question is that, can we find anything which resembles to stability? So there is this exchange rate stability ratio, which practically analyzes that how stable the currency is. If it's close to 1, then the currency is stable. If it's not, then obviously it's not stable, so we could go towards 0. So the major impact would be that, okay, interest rate premiums, what we are learning at international finance in the textbook, it should work nicely. Unfortunately, if you are checking the literature, so even Krugman, who is writing the book which says that it should work, has this paper where he said that this is a nice theory, just it doesn't work at the short run. Sometimes if the political risk is considered low, and also when the market is calm, then this works, but otherwise it's nowadays it's absolutely debated, or there are even papers which are saying that if they are highly exposed towards a foreign currency, not just in case of revenues, but also in case of debt, then this will work backwards. So you are not able to stabilize your currency with interest rate policy, which is quite contradictory, but unfortunately this is the reality. So of course we cannot just have indirect interventions with the interest rate, but also we can have direct interventions with the reserves. So if we are checking that, how does it work? So in advanced economies, this is the real sovereign premium. So we can see that sometimes it was significant negative impact between 2005 and 2007, or in the time period around 2014, or around 2019 until 2020. So this was working backwards. But sometimes I was able to identify 2 cases since 2000 when it was actually positive and was significant. So yeah, because we don't have proper interest rates since 2008, so this can be one reason. And once we have proper interest rates in 2023, now we can see that, okay, this is significant. Right now, these figures are completely ugly, just I had no time to clear them yet, because I can't work on it right now. If you are checking emerging markets, then this real sovereign premium, this doesn't work at all. So, okay, I was able to find 2 examples when for several months it was significant and positive, but otherwise we can see this is a complete mess. If you are checking it with not as a rolling regression, what you were able to see, but focusing on the whole entire time period, still we can see that for emerging currencies, this interest premium, it's not significant at all and doesn't have any kind of a contribution. So it's completely dead end. If you are checking the foreign exchange reserves, then they have a positive, so they can stabilize the currency and have some really weak impact. So mostly what was driving everything was the implied volatility from the stock market, which is really strange, but that was absolutely robust. Doesn't matter if you are talking about emerging currencies or advanced currencies. At least for advanced currencies, the interest rate parity works better-ish, 1% share from the overall volatility of the exchange rate. So this is still really weak, but at least this is positive and significant, which is quite rare for 4 months ahead. So we are talking about really small time frames. So if we have to model any of this relationship and we would like to forecast this, then the primary issue is that it's really hard to find anything which can describe this behavior. So right now we have the other paper under review. So this will change sooner or later, but the original problem was that if you are checking the literature, we can see so many different suggestions that, oh, we should focus on volatility, we should check what is happening with gold, we should check what is happening with oil because of import prices, we should check what is happening with unemployment, or what is happening with external volatility, with US dollar liquidity scarcity, with currency-based swap lines. So if you are checking everybody, in the literature we can have monstrosity tables like this that obviously we are not able to use all this variable at once in a regression for forecasting because this will go nowhere. So nothing will be significant and yeah, it will be just creating noise. So it was like, this paper is much more like testing that, okay, which variable can be useful. So within each subgroups, we were checking, there is this beautiful method of Bayesian model averaging. And then we were testing that, okay, there is this probability which says that if it's close to 1, so 100% of probability, then it will affect the behavior of the euro to Hungarian forint. If it's not, then obviously it will not affect it. So we can see that for this specific currency, so unfortunately we have to do it for all the currencies where we have to analyze anything. So in this case we can say that yes, maybe foreign debt ratio has a 53%, 53% is the probability that it will have an impact, which is something. If you are checking that what is happening with the long-term interest rate differential compensated with the inflation, then we can see that, oh, it's 99%, 99.9% is the probability that it will have an impact. Which is strange because it has negative. So this should have positive influence, but according to the literature, this is not working. or it's working backwards, and this is what we can measure. In the past, before I was able to see these paradox papers, I was always assuming that did I have any kind of database error or what is wrong with this, but it's coming back. Doesn't matter what kind of methods will you use, vector autoregression, VACM modeling, or even this Bayesian approach. This is quite robust, that you have something negative here. If you are going down to short-term interest rate, then we can see that, okay, this is skewed positive, but also the probability that it will affect this, it's only 67%, which is nice, but not that nice. Also, we can see that obviously central bank balance sheets, because of the unconventional monetary policies, it can have an impact on what is the structure of loans, securities to foreign exchange reserves, or the size of the balance sheet. But it doesn't matter what is happening with the ECB. It doesn't add much value. Or what is happening with unemployment, so who cares about country fundamentals? That has nothing to do with exchange rates. Or what is happening with the liquidity availability of US dollar in case of euro or in case of Hungarian forint. So currency-based sweat lines are not working. But Euro stocks market implied volatility, this is 100% there. So we can use this one for modeling purpose, and also what is happening with the central bank and what is happening with the interest rate, if you are considering that this is working backwards. But otherwise, Brent oil or gold is, again, doesn't have much added value. So that's the problem of maintaining currencies outside the Eurozone, and also the problem of emerging currencies at all. That at least for advanced currencies, for US dollar euro ratio, still we can say that, okay, let's use this differential. Mostly it will prefer or operate this way, even it has a positive coefficient. But if we start to dig into open and small economies, we will win all this mess, unfortunately. So this is the hard part for modeling. And just to be nice, then the reviewer was asking us that, oh, we should include even more variables. So now we have to review also this paper or revise this paper, because the problem was that it was not enough variable which was included in the tests, that we should extend this further. So this is a nightmare on itself. So if we have to test this for the euro and US dollar relationship, we will do it on the seminar, because this is much more like a practical analytical thing, not theory. So we will do this foreign exchange forecast tomorrow to see that how can we first we will define the position, obviously, what must be covered, and then we will start to check the different methods of futures market data. We will do Gauge model simulation, because in this case we can see that, okay, if we are defining parameters for volatility model, and then we are just estimating 100 runs of these models, then what can be the possible change in the exchange rate 1 year ahead, and after that for 5 years ahead. So this can be useful because it can be a good stress test for the business plan. Or also I will show you how to do proper VAR modeling, because in this case we can have this macro model, what I try to show you with relevant variables, and after that we can see that, okay, this is working or not. Mostly it's not working, so it's really hard to achieve any kind of significant result, but at least I can show you how it should be done. And also we will check futures market. So here is the historical trend data. So obviously if it's clear that it's appreciating, depreciating, then it's really easy, or even Excel can do some kind of a really simplified and stupid forecast for us, because I can fit this linear line easily. Okay, Excel is so proud of this. where are you? Yes, so we can do this Monte Carlo simulation, and after that we can see that, okay, what is the expected value? So where the most of the 100 simulations are going after a year, and what is the upper 5%, what is the lower 5% to see the extremes, and after that we can just test the company that, okay, what is happening if we are stressing them out, which is really useful because in this case we can say that, okay, the company or the exposure is relevant for the company or not, because if value is not changing, even if we are stressing it with extreme jumps, then who cares about this exposure? This is brute force, but nice. Done, and this is the forecasting model. Yeah, impulse responses, blah blah blah. So we should do some kind of curvy thing like this, which looks forward. Okay, this is quite an old-time series, but tomorrow we will do our own. And this is significant because this is not crossing zero, so all the confidence interval lines, so this one is the positive confidence interval, this is the lower confidence interval line, this is the median, so this is supposed to be the exchange rate trajectory for the euro-US dollar rate, and we can see that this is showing some kind of an appreciation. I don't know which one is the US dollar euro, so okay, one should be appreciated and the other is not. So in this case the euro is weakening against the US dollar. So we will see that how this stuff works, because I think that this is the best part, because we can do experiments on empirical data, and then we can compare them that, okay, what is expected by the market here, and also what is provided by proper econometrics.